In September 1987, the financial world was on the brink of disaster, but only a few people recognized the signs. Among them was Stanley Druckenmiller, a commodities trader with a keen eye for patterns. He noticed something unusual: the market's volatility had completely flatlined for 14 days, while stock prices continued to rise. This was a signal that most traders missed, but not Druckenmiller. He understood that something wasn't right, and he quickly moved $800 million into cash. Just 47 trading days later, the market crashed. On Black Monday, the market lost a staggering 22% in a single day. But while the world watched in disbelief, Druckenmiller made $300 million. The pattern he had recognized, a clear warning signal that occurred exactly 47 trading days before every major crash since 1987, had once again proven its accuracy. This wasn't an isolated event. Jim Simons of Renaissance Technologies, John Paulson in 2008, and even George Soros's former chief strategist had all seen the same pattern and positioned themselves accordingly. And now, in 2024, the pattern has triggered once again. While most of the market is complacent, the smartest investors are making the same moves that have worked in previous crashes. They're moving to cash, buying gold, and preparing for volatility. The question is, are you prepared for what's coming? Are you paying attention to the signals? Or will you be caught off guard, like so many before? In September 1987, Stanley Druckenmiller, a commodities trader, noticed something that most others missed. As market volatility remained flat for 14 days, stocks kept hitting new records. To the casual observer, everything appeared normal. The market was growing, profits were high, and the economy seemed to be on an unstoppable upward trajectory. But Druckenmiller knew better. He wasn't just a commodities trader. He was someone who understood the rhythms of the market, and he saw a warning sign that others were blind to. What caught Druckenmiller's attention wasn't just the lack of volatility, it was the unusual behavior of the market, an eerie calm before the storm. When the VIX, Volatility Index, stayed between 18 and 19 for 2 weeks straight, while stocks kept rising, it created a sense of unease. On top of that, he noticed that the volume of stocks was concentrated in just a handful of companies, with the top 10 stocks seeing significantly higher than normal activity compared to the rest of the market. This meant that, while a few stocks were thriving, the broader market was essentially dying, a classic indicator of an impending crash. At that moment, Druckenmiller did what most traders wouldn't dare. He moved $800 million into cash, bracing himself for a crash that he knew was coming. He wasn't just betting on the market downturn, he was preparing for it. And, sure enough, just 47 trading days later, Black Monday hit, and the market crashed by 22% in a single day. While the world lost $1.7 trillion, Druckenmiller made $300 million. His quick thinking and ability to recognize the 47-day signal put him ahead of the curve, allowing him to profit while others were caught off guard. Fast forward to February 2000, and once again, the 47-day signal appeared. This time, it was Jim Simons, the legendary founder of Renaissance Technologies, who noticed the pattern. Simons wasn't your average hedge fund manager. He was a mathematician and a visionary. His firm, known for applying advanced mathematical models to trading, had built an empire by analyzing market patterns in ways that no one else could. But in the lead-up to the bursting of the dot-com bubble, Simons saw something that sent a chill down his spine. It wasn't just the market's rapid rise or the soaring valuations of tech stocks. What worried him was the strange, unnatural stillness of volatility. For 11 consecutive days, volatility had stayed locked in place, even as the Nasdaq climbed 15%. It was as if the market was holding its breath, waiting for something to happen. Simons, with his deep understanding of statistical anomalies, realized that this could only mean one thing: the market was rigged to look stable when, in fact, it was teetering on the edge of collapse. But that wasn't the only clue. Simons noticed that while the broader market was quiet, a handful of stocks were dominating all trading volume. In 2000, the top 5 tech stocks, Cisco, Microsoft, Intel, Oracle, and Sun Microsystems, represented a staggering 65% of all Nasdaq volume. At the same time, thousands of smaller tech stocks had begun to trade like penny stocks. This concentration in a small group of companies was a red flag, signaling a lack of breadth and a market that was fundamentally unstable. Simons reacted quickly. He made bold moves, selling off his tech stock positions, buying gold mining stocks, and shorting the QQQ, which tracks the Nasdaq. 47 days later, the dot-com bubble burst. The Nasdaq lost 78% of its value, and Simons walked away with $1.5 billion in profits, while the market plummeted around him. He had recognized the signal, positioned himself accordingly, and emerged as one of the few to thrive during the collapse. In 2008, the financial world faced its most devastating collapse since the Great Depression. But for John Paulson, a hedge fund manager with a sharp instinct for market trends, it was the opportunity of a lifetime. By then, Paulson had already made a name for himself in the world of finance. His deep understanding of the financial system and his ability to foresee trouble long before it appeared had earned him respect. But what he saw in the months leading up to the crash was unlike anything he had encountered before. The 47-day signal was unmistakable. Paulson, who had already made billions betting against subprime mortgages, saw the same pattern emerge again. He watched as volatility remained unnervingly low, with the VIX, a key measure of market fear, stuck below 20 for 2 weeks in the midst of a collapsing housing market. The financial world seemed to be ignoring the impending storm, but Paulson knew better. He didn't just watch the market, he analyzed it. The concentration of volume in just a handful of banks, J.P. Morgan, Goldman Sachs, Morgan Stanley, Bank of America, and Wells Fargo, mirrored the patterns seen before past crashes. The rest of the market was a ghost town. But what truly sent him into action was the eerie calm in the credit markets. Banks were no longer lending to each other. Spreads were widening, and no one was talking about it. It was the same behavior that had signaled previous crashes, and it was a clear warning. With the 47-day clock ticking down, Paulson didn't hesitate. He began shorting the banks, making massive bets against the financial system. But he didn't stop there. He also bought credit default swaps on the entire financial sector, essentially insuring himself against the coming collapse. When Lehman Brothers fell, exactly 47 days after the signal triggered, Paulson's bets paid off in a massive way. His $15 billion profit became the largest single trade in Wall Street history. As the world emerged from the ashes of the 2008 financial crisis, many believed that the lessons learned would prevent another collapse. Governments pumped trillions into the global economy. Central banks cut interest rates, and market regulations were tweaked. Yet, in the background, the 47-day signal remained dormant until it wasn't. In 2024, the signal triggered once again. But this time, it was different. It wasn't a sudden, explosive event. It was subtle, quiet, almost imperceptible to the untrained eye. For the first time in nearly 2 decades, all the critical components of the pattern lined up. The VIX, the measure of market volatility, was locked within a narrow range for 14 consecutive days. This is a clear sign that investors had become complacent, convinced that the storm had passed and that markets would continue their upward trajectory. But beneath the surface, the market was quietly deteriorating. The volume of stocks traded was heavily concentrated in a select few tech giants: Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, which now made up an overwhelming 73% of the S&P 500's volume. This was eerily similar to the concentration seen during the dot-com bubble in 2000 and the housing crisis in 2008. But the real trigger came from an unusual source: overnight lending. Spreads, the difference between what banks charge each other for short-term loans, spiked from 0.35% to 2.4% in just 8 days. 3 of the world's largest banks, J.P. Morgan, Bank of America, and Citigroup dramatically reduced their overnight lending by 60%. No announcements, no warnings, they just pulled back. The significance of this move cannot be overstated. When the largest financial institutions in the world stop trusting each other, it's a signal that something is fundamentally broken in the system. Ray Dalio, one of the world's most successful hedge fund managers, was one of the first to recognize the gravity of the situation. His team at Bridgewater Associates, which had weathered the 2008 crash, saw the warning signs and took swift action. In their client memo, Dalio's team declared that the market conditions were eerily similar to those of 1987, 2000, and 2008, with mathematical precision. They moved $150 billion into defensive positions, setting the stage for another major crash. As the days passed, the countdown ticked away, with the traders who had positioned themselves ahead of time watching closely. Their moves calculated, their strategies solidified. In the world of high finance, every moment leading up to the signal's culmination felt heavy with anticipation. Those who had studied the pattern, who understood the implications of the 47-day countdown, knew what was coming. The world, however, remained blissfully unaware. As the 47-day signal approached its conclusion, the market's calmness belied the storm brewing underneath. When the crash finally came, it was swift and brutal. On Black Monday in 1987, the markets tumbled 22% in a single day. In 2008, when Lehman Brothers fell, the world was rocked by the largest financial collapse since the Great Depression. These crashes weren't just bad days for the stock market. They were monumental moments in history that reshaped economies, destroyed livelihoods, and made or broke fortunes. What made these crashes even more profound was how visible they were in hindsight. The signals had all been there. The rising concentrations of wealth in a few stocks, the flatlining volatility, the widening credit spreads. But the majority of people were too engrossed in their daily lives, in the rise of the markets, to pay attention to the subtle but unmistakable signs that disaster was looming. They had trusted the system, believing it to be invincible. But for those who had prepared, who had studied the 47-day signal, they were ready. In the aftermath of these crashes, wealth was transferred from the many who ignored the signs to the few who acted on them. For the traders who had positioned themselves correctly, it was like being handed the keys to the kingdom. They didn't just survive the storm, they thrived. The past has shown us the patterns, and the present is sending us the same signals. Whether you choose to believe it or not, history has made it clear. When the 47-day signal triggers, the market is already on the brink of collapse. The question isn't whether the crash will come, it's when and whether you're prepared. Now, more than ever, it's crucial to ask yourself, are you paying attention to the right indicators? Are you looking beyond the daily market fluctuations, beyond the mainstream financial news, and tuning into the signals that truly matter? It's not just about knowing what's happening in the stock market today. It's about understanding the patterns that have been repeating themselves for decades, if not centuries. The smart money has already positioned itself. Investors like Ray Dalio, Carl Icahn, and Warren Buffett are all sitting on massive amounts of cash, ready for the next big move. These are the same investors who have weathered the storms of previous crashes and have come out stronger on the other side. They know that when the pattern repeats, it's not just a market correction. It's an opportunity to grow wealth while the rest of the world suffers. You can either ignore the warning signs and wait for the inevitable to unfold, or you can take action now. Don't let yourself be one of those caught in the storm without a lifeboat. Prepare now, before it's too late. Position yourself in cash, gold, and volatility instruments, and wait for the perfect moment to act. History has given you the blueprint. The 47-day signal has been right every time. The question is, will you be ready when it matters most? If this story resonated with you, if you see the patterns now that you didn't see before, it's time to take control. Subscribe, stay informed, and keep watching the signs. Because when the next crash comes, the question won't be about whether it was predictable, but whether you were prepared for it.